Well, hi there and welcome to our special coverage of GST and what it would mean for the markets. One day to go and GST will become a reality for the Indian economy. The most historic reform which will change the course for India's economic development going into the future. I'm Tanvir, Gill in the Mumbai News Centre. Welcome to this show. We'll of course, as always, delve each day on one aspect of GST that will have the markets talking. In fact, with just one day to go for India's biggest historic tax reform, we of course will continue with our special coverage just with GST, the street view. We are now joined by Sanjay Mukim, India equity strategist at BofA to talk about how one should be looking at the new regime and what it would really mean for the growth trajectory as far as the Indian economy is concerned. But before anything else, let's lay ground on one important aspect within GST that will be taking center stage, once the bill becomes a reality or once the reform becomes true nature come 1st of July. Anti-profiteering clause is among the most crucial parts of the historic tax reform which is being undertaken. Ajay, of course, joins me from the research desk to highlight its importance and what the street is saying on this very important subject. Ajay?
Well, that's correct. The anti-profiteering clause is one of the most important clauses and part of the GST. In fact, interestingly, is making large part of the corporate sector and the listed space in the market slightly nervous. Of course, clearly, the objective of this clause being added by government is that the GST may not have an inflationary impact on consumers and in the economy. They go on to say that significant savings because of lower rates, whether they are direct lower tax rates or via input credit, the overall cost of taxes is going down, should not be retained by the company but should be passed on to the consumers. In fact, they are trying to have a disinflationary impact on the consumers and the economy. In fact, to ascertain that this is being conducted in a fair manner, the government will also form an anti-profiteering authority who would look at the methodology in wherever there are indications that people have tried to or companies have tried to retain much more than warranted on their own books. However, analysts in the street, experts whom we speak to, do not rule out some amount of retaining of additional benefits by select sectors, select companies. It may be very difficult to actually go ahead and take out every penny which is being saved by the company according to them. However, the intention is good, but it may also lead to a lot of litigation according to some of the experts. They go on to say that the intention of the government is good, but to implement it may lead to some amount of litigation. That is because analysts believe, like Credit Suisse, that the genuine cases of cost savings should not be penalized or scrutinized, because in that sense you are actually penalizing the company because of cost savings, because of better product mix, who's trying to improve their margins. They should not come under pressure. Similarly, CLSA says that absolute capping of margins will dissuade companies to adopt best practices to cost savings. So this is the kind of mixed response we are getting right now, but nervousness there definitely is on the street and among the corporates.
Fair enough. Thanks very much, Ajay, for summing it up for us in terms of what the anti-profiteering clause would do to protect consumer interests. Sanjay, good to have you on the show. Good evening. Thanks very much for taking out the time. What have you made of this clause as of now and the stringence with which the government would want it to be implemented, whereby which consumers at their end do not feel shortchanged by businesses in transferring the benefits that they may avail under the new tax regime?
Well, Tanvi, I think the anti-profiteering clause is in first a statement of intent by the government that they would like businesses to pass on whatever tax savings are made under the GST to consumers. However, if you think about it, in a country of 1.3 billion people, hundreds and thousands of enterprises, it is extremely difficult to have the institutional capacity to monitor margins across businesses and companies. So much of the action, I believe, of the anti-profiteering body will be on a complaints basis rather than for them to take suo motu action against companies. Just practically impossible for that to happen. somebody will have to go to the authority and point out a particular business or an industry which they think has not passed on GST benefits to consumers. The second layer, of course, is establishing the fact that the margin expansion that the company has retained is in fact because of lower taxes, not because of improvements in other costs or product mix. Again, this becomes very difficult to establish, and it will, of course, create challenges in litigation. I do not think that this is going to become a very pervasive sort of a issue. Again, I suspect this has been introduced into the law more as a statement of intent, more to tell companies and businesses that you should try and pass on whatever tax savings you have to consumers. I suspect it is be extremely impractical to roll out on a mass scale across the country.
No, I understand that. But do you think even if it's work in progress, Sanjay, as the bill by itself and its implementation would be, the government indicating that they are looking at setting up a national anti-profiteering authority which can deal with these sort of gaps errors in the system, can process complaints where, the pass-through has not happened, would be perhaps a step in the right direction. I'm not saying it may happen overnight, but as long as the government is trying to put the checks and balances in place, at least the direction is right.
Well, yes, from a policy perspective, it makes sense to ensure that tax savings are passed on to consumers, that there is no profiteering on the back of or a windfall gain to companies because of a change in taxation. However, if you think about it, 1 year, 18 months down the line, this will no longer be necessary because the prices and margins would probably have stabilized. So this will prove to be a temporary measure, and for the while that the taxes are transitioning. Like I said, it's probably not necessary 1-2 years down the line anyway.
Interim, do you think that these gaps in the system and perhaps, like I said, the lack of clarity may lead to an interim boost in inflation, something that would get the RBI also a bit conscious about whether or not to go ahead and cut rates? And I tell you this because many countries that adopted GST in the past, Singapore and Australia, they witnessed the same sort of reaction once the model came into place.
Right, so this is a big unknown in India. In fact, we did a short survey today where we went and met about 25 retail storekeepers. We asked them what prices will do post the GST, and surprise, surprise, not one seems to know what will happen to their good or how their businesses will fare after the GST comes into play. So I think it is a risk. We don't know really whether inflation will go up. The way the rates have been designed, they're broadly similar to where the old rates were without taking into effect the input tax credit. It seems unlikely that there will be inflation. Conceptually, there shouldn't be because the headline rate is similar to the old one and you now have better input tax credits. So it should not be inflationary, but the risk is that the misunderstanding, the gaps in people's processes may lead to some sort of pricing upside in the short term. I wouldn't be too worried about it, to be honest.
Now, Sanjay, let's talk about how you're looking at your India strategy in lieu of GST becoming a reality. Have you at all worked within a range what GST could do for earnings in FY18? I mean, FY19 is a foregone conclusion. There's going to be a big boost in numbers. But how does one actually navigate through this year when it comes to earnings in lieu of the spectacular rally the markets have already witnessed?
Look, given the rich valuations of the market, any hiccup in numbers should ideally be a risk to worry about. Okay, and the GST is, if indeed a hiccup, at least to the June quarter and potentially the September quarter as well. The magnitude is, of course, very difficult to establish, but it should be noticeable. We already hear commentary from many companies telling us that their sales are weak. We know through experience that destocking is relatively visible across most stores in the country. And whether the market looks through this or not, I think will be determined by the mood of the market at that point in time. We keep highlighting in our strategy notes that India is joined at the hip to global equity sentiment, to emerging markets, to global equities. All charts are almost 100% correlated for a long period of time. Indian strategists, all of us sitting here like to talk about Indian growth and try and explain the multiples by pointing to the growth. But that really is not why stocks are at 30, 40, 50 times earnings in India. It's consumer, discretionary, staples, all have re-rated everywhere in the world as well. India just happens to trade at a premium. In that environment, I am not so sure that the GST hiccup in itself will lead to a meaningful correction in the market. This is especially if you remember after the demonetization, a lot of our investors got the demonetization trade at least incorrect when they sold into demonetization. The GST at least can be argued to be good for the country over a 2-year period. And having had the poor experience of selling in December, I suspect not too many will be eager now to sell any temporary GST bump. I therefore I do think that numbers will be affected, but I am not sure that the market will react meaningfully on the downside just because of GST. We are already starting to see, however, global jitters in equity. If that were to continue, then that could be the reason Indian markets take a leg down as well.
Suffice to say, the very narrow range that the market has been trading in, the last 15 odd days, where the levels are being slowly, gradually adjusting lower. You don't think this is squaring off of positions, taking positions off before GST becomes a reality? You think this is more in tandem with, just valuations looking a bit stressed, so traders being a bit cautious?
Yes, there is a dearth of ideas, to be honest. I mean, you can find growth, you can find value, but there is no overlap between growth and value in India anymore. Plus, as I said, you have seen jitters all across the world. It's not just Indian equity that has taken a breather. We've seen equity markets elsewhere also pause. So we are doing that in sympathy as well. And if you start seeing global rates go up, global inflation expectations go down, and emerging market asset classes as a result correct, then India again will not be decoupled, especially with the concerns around the GST around the corner. So I do think that we are susceptible as a market, and our advice to investors has been to avoid risk in India, risk being liquidity and operations, because markets are fairly valued. But again, like I said, the GST in itself, absent any other external stimulus, may not be sufficient to cause a noticeable correction.
Fair point, which is why you're cautious in the near term. Sanjay, stay on with us. Lots more to talk about, especially, delve a bit into individual sectors and opportunities thereof in lieu of GST unfolding and becoming an integral part of the Indian economy. Hear out Harsh Upadhyay from Kotak Mutual Fund talk about his market sense as well. When we come back, it's going to be really about GST-led trades in the market.
There is going to be a clear shift from unorganized segments of many of the sectors, and these will move into organized, listed, branded players. So the incremental market share gains are going to be gradually in favor of organized players. The tax arbitrage which was giving them pricing power for the let's say unorganized sector is unlikely to remain going forward, or at least it's going to minimize. So to that extent, it's going to be a better playing field for organized players, and hence we believe with their brand equity, with their quality, they will be able to gain incremental market share from unorganized players in many cases. So the burden of tax compliance will increase on smaller players. They have not been used to do this, so there could be more implementation hiccups at their end compared to some of the larger players. So that will again aid incremental market share gains for organized players. Medium to long term perspective, I think it's going to give a better earnings growth trajectory for listed players. But in the short term, there could be ups and downs. But between June and September quarters, even that should get normalized. There are opportunities across many industry subsegments. Most of them are consumer centric. It could be in consumer staples, it could be in consumer durables, or it could be in the area of home improvement.
Welcome back. You're still watching our special coverage, Tryst with GST, the street view, and I'm still in conversation with Sanjay Mukim of Bank of America Merrill Lynch. Sanjay, I was just scanning through the list of gainers and losers, from a sector perspective. So we've seen the rally in consumer stocks. That reflects that the market is very upbeat on what the new regime would mean for these companies. That's been pretty much the case with the logistic companies as well. Airplanes too, GST will be just 5% on economy flying, so I think there's some upside there as well. But for names within the consumer durable space, the automobile space, it's a mixed picture. How do you look at the sectors which may go through a bit of a struggle when it comes to adjusting to the new regime or to the new tax reform?
Well, first I'd say that there is no obvious trade on the GST in the market, simply because that would have been through lower tax rates. Now, that has not really happened. Across most spaces, most industries, tax rates have been largely kept similar to where they are. There hasn't been, significant reduction in rates for many sectors. So that trade is not available. The difficult trade is available, which is for companies to use the GST and either gain market share from their unorganized counterparts, to try and expand the market, or through better product mix and so on. But what I would argue is that given the expectations that's inbuilt into many of the stocks now, it is only post evidence of that happening that I get further upside. Much of the hope of GST in many of the staples, many of the smaller sectors has already been factored in, logistics like you said, or consumer durables. And I need evidence that the GST is working for many of these before I think you start to get a fresh leg to these subsectors or to these stocks. And therefore, like I said, there's no obvious trade at the moment. I don't see too many downside ones as well. All I'd say is that the service sector, which is, let's say, banks or telecom, will have a far larger compliance cost because they now have to file in more states, not just to one sector, and to not just to the center, and therefore their costs may go up. But I don't see too many large evident losers of the GST as well.
Okay, but these compliance costs, how would they work in? Because we know what the story is with the telecom. I mean, the bias is really towards spending more in whichever form and shape. So, another cost perhaps bearing on their P&Ls? Yes.
And the drill, right? Telecom service tax is now payable in each state every month. And allocation will become an issue. These things need to be sorted out. They will probably need to add more tax people, more IT systems. Of course, I'm sure most of them have already worked on it, but some portion of higher costs can be expected post the GST. I mean, it should stabilize. The GST is very automatic. It's very technology heavy. Once you're able to automate it, once you're able to get the processes in place, then the cost should probably come down. But while you're doing it, while you're getting your vendors up on board as well, a lot of effort, time and money is going to be needed. And this is not just for telecom. Telecom or services will particularly face this brunt. But most companies will have a lot of cost initially, while in both time and money, in how they adapt to the GST, how they get their ecosystems, vendors and consumers, to understand the whole process. So the market is going to see higher costs in most places for some time.
One could only wish one could help the telecom space, but they've had their good days in the past where they've seen, supernormal profits. But, just to wrap up, Sanjay, because we have very little time now, as a theme that would clearly stand out, even though it's coming at a price, one continues to bet with the consumer stories, the consumption names, the FMCG stars, Colgate, Heritage Foods, Marico, Dabur, Nestle, HUL. For that matter, even ITC, barring what's happening with the tobacco business. But do you think that's where the focus should lie in terms of buying even at these levels?
Especially if you have a longer term investment horizon. It's extremely difficult to say in a 2-month space. But if you are a long-term investor in India, it's one economy which is consumption driven and has growing standards of living or higher per capita income, very visibly over the next 3 to 5 years. We did a note on this some time ago to argue why the drivers are stronger than you think. India's growth is perhaps more assured than you would imagine. And because it is a consumption-driven economy, strong consumer companies, those that have moats, those have good business models, should continue to compound. In fact, this is an argument we made that India actually has the most number of compounders, or the highest yield of compounders in its equity compared to any other global large market. And that's simply because we are consumption focused and growing. That theme will play out. The GST can only help facilitate some of that, but the underlying currents are extremely strong anyway. So if you have a long-term horizon, I do think India inward-focused companies, good ones, are the way to go.
Okay, the Indian consumption story can never fail you. And that's even under the new regime, that pretty much holds true. But Sanjay, great to have you on the show. So nice speaking with you. Appreciate your time and your insights as always. We
great
call
to be
it
on.
Curtains then on the show. Thanks very much for watching Chris with GST, The Street View. We carry on with our non-stop coverage on what GST would mean for India come 1st July through the course of today evening. So stay tuned to the channel for more on that.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.